Thank you for tuning into the Buyer's Guide podcast, where we talk all things property and finance. My name is Peter Mastriani, the founder of the Buyer's Guide, which has been established to really help as many people as possible buy their own home through to building a property portfolio to secure their financial future. Today we've got a catchy little title in terms of using other people's money to build wealth. In actual fact, what we are talking about is debt, how to use it and how to manage it effectively and combine it with the right lending structures to create long-term wealth for your property portfolio. So, let's get to it. Debt is commonplace, so commonplace that everyone actually has it, well, at least in one form or another. Now, there's really nothing to actually be embarrassed by having debt. It only becomes unmanageable when you either ignore it or it goes beyond your means. And managing and maintaining your debt is easy to do when you actually understand what it's all about. So by understanding why things the way that they actually are, you can find easy solutions to overcome your own individual debt problems. Now, whilst debt may be considered a dirty word, it's also an excellent wealth creation tool. Now, there's a distinction between the two, and it's very important to point out that not all debt is created equal. Debts would be so much easier to manage if they were. So you have to understand the subtle differences. It really is critical because good debt and bad debt can often coexist. What you actually want to achieve is to reduce or eliminate all your non-tax deductible debt, or in other words, bad debt. Thereafter, you want to structure the remaining debt, your good debt, in a fashion that actually maximizes your ability to create wealth against, the backdrop of your numerous other financial commitments or numerous other financial matters that are going to relate to your own individual circumstances. So to give you a quick hypothetical scenario here, let's say you come into an inheritance. You receive a $125,000 inheritance and you decide that you're going to buy shares. Now, in that same breath, you also have a $250,000 outstanding mortgage on your residential home loan. Now, to some, this may be the right move. It's not though, because that $125,000 should go straight onto your home loan, as that's the non-tax deductible component, and you should borrow $125,000 to purchase shares. That way, you've manufactured some good debt, and you've done so for tax deduction purposes. That's one example of many. And some common debt mistakes that I often see is, one, that people maintain several different debts. For example, they have a credit card, they've got a car loan, a personal loan, a home loan, and they don't combine the debt together or use equity in their home loan to actually repay their higher interest debts. Secondly, a big mistake that I often see is people not maximizing the full potential of a 100% offset account. Obtaining a loan product that actually has all the bells and whistles and not utilizing all of its features can actually be a costly mistake. In actual fact, you would have probably been better off just going with a no-frills product, because that would have actually attracted probably a lower interest rate. And look, it goes the same way. If you're only keeping $50 or $100 in that offset account, again, it's really no point maintaining it. Now, thirdly, a big mistake that I do see quite often is that, poor loan structuring and poor product selection can often be wrapped around investments. And lastly is, purchasing an investment property with your partner, holding it actually in joint names when one of the individuals actually earns significantly more than the other. The advantage in this situation would be to hold the title under the higher income earner for tax purposes or for a higher tax deduction. Now, the reason why I hear often is that the property is held in joint names is because people actually have a concern about what will happen to the assets if there's a separation. Look, what I should say is that if there are concerns about ownership, family law will actually override titles. However, if there are doubts about relationship potential, maybe question whether buying a property is going to be a worthwhile decision. Um, it's funny, we're talking about debt and suddenly we're starting to give away some relationship advice. But anyway, look, if you are looking at investments and property to generate wealth, which you should be, then it makes a lot more sense to actually pay down the non-deductible debt. It can be then redrawn to fund investments and create future wealth. Making smart decisions when it actually comes to financing can be a lot easier when you actually have the right advice as well. Good debt can become a powerful wealth generation tool. Now, appropriate structures wrapped around growing assets, like property, for example, can increase at a higher rate compared to the actual cost of the borrowing in the first place. So when you actually use the equity to fund investments, it becomes a lot more efficient as compared to actually paying off the debt with your surplus funds. Plus, good debt becomes tax deductible, adding yet another cherry to the actual equation. Now, creating good debt and the borrowing power that you actually possess, will become the cornerstone in your ability to actually achieve success as a property investor. So if you establish the right portfolio, it really does become easy to build upon. You do need to consider, though, your investment plan and perhaps be thinking about maybe even 2 or 3 loans in advance. People will often make the mistake of sticking with one lender and cross-securitizing their properties. Or the focus is, just on short-term interest rates that are actually being offered, and actually forgetting that the right structure is going to extend your line of credit and actually save you substantial interest over the life of the loan. Now, loan structuring is very individualistic, as there's a number of variables that can, influence the outcomes. Plus, there's dozens of lenders and hundreds, if not thousands, of different products that are actually available, each all with their own little characteristics and peculiarities. So, what are the actual factors that will influence your loan structure? Well, firstly, you need to take into account the 5 C's of credit, being your capacity, your capital, your collateral, and the conditions that are going to be part of the loan, and also your own individual character, and how each of those 5 C's are going to relate to you directly. Another factor is going to be timeframes. Another thing to consider is whether you're going to pursue an active or a passive investment property strategy. Active being, that you're going to do subdivisions and renovations and flip property and do developments, or a passive style where you're buying an asset and holding it over a long period of time. Another factor to consider is your risk tolerance, and also the amount of flexibility that you're going to require. Now, it's really important that not only should you consider what is best for you now, but also how these decisions are going to impact you in the future. You really need to maintain a clear plan on your property investment intentions, because it's going to boil down to your finances and how you structure your debt facilities. Now, the right structure could save you a fortune and will make it much easier and much more effective to actually build upon. So, setting up your loan structure correctly, i.e. being in line with your actual investment strategy, is going to create some positive outcomes. Now, these outcomes are going to be 1, tax efficiency, everyone has to pay tax, but there's no point actually tipping the tax man at that point in time as well. So tax efficiency is a big one and certainly on everyone's agenda. So by optimizing your tax position, it's going to really help improve your cash flow. And cash flow is the lifeblood of any growing property portfolio. A common problem that is actually faced is, having an inefficient split of deductible and non-deductible debt, like we spoke of a little earlier. Now, larger loans should be associated with, financing tax deductible debt to offset your income. If the larger debt was actually associated with your home loans, this would not be possible. So don't make the mistake of your home loan being too large a proportion of your total debt. Now, another aspect to consider when structuring your home loans is flexibility. And you want to have flexibility because you want to be opportunistic. So, you need to be in a position that you can access your money quickly and take advantage of opportunities when they arise. It's going to be hugely beneficial for you. Maybe not even property opportunities or investment opportunities. Perhaps you could look at refinancing if a lender really comes out with a cracking rate. Flexibility really is key because you will want it and you're going to need it as well, because you're going to need to make changes from time to time. So having flexibility within that loan structure is really important. Another factor is obviously risk management and covering scenarios that may actually hinder your ability to maintain your payments, whether that be through periods of unemployment or perhaps long periods of illness as well. So if something unfortunate was to actually happen and you ran into some difficulty, you may decide that you perhaps need to sell a property or some investments to actually free up that cash and cover those unexpected expenses. Now, if you don't actually have the right structure and flexibility, then the bank can actually control the sale proceeds and force you to repay debt rather than access the funds to actually stay afloat. Another positive thing about having the right loan structure is that you actually have easier admin. It's the account keeping becomes more straightforward, and that equates to a happy accountant and a paper trail, which is obviously going to appease the ATO. So having the correct structure ensures that you're going to have a sound basis for actually claiming deductions by separating the loans by each property and for each loan purpose as well. Very important is having standalone loans. That's going to create your greatest flexibility. Cross-securitizing your loans will only lead you to trouble. So you need to establish standalone loans that are going to be secured against one existing property only. That way you can finance a 20% plus cost purchase and arrange a separate loan secured against a new property for the remaining 80%. And lastly, you need to think about planning. The right structure, it can create some contingencies which are going to cater for, life's unexpected journeys, which always will happen. So structuring correctly will let you plan out your investments ahead, and therefore it's going to allow you to, execute your strategy and be able to anticipate those timelines when you actually want to achieve your goals. So, look, today's been a heavier topic for sure, but it's one really worth understanding, particularly around debt and having good debt, part of your investment strategy, and also structuring your assets to have the most efficiency from a taxation perspective, from a cash flow perspective, and to create those contingencies, whether to be opportunistic or for asset protection and for risk management as well. So if you would like to have a free consultation on what the right structure could be for you, then be sure to visit www.thebuyersguide.com.au and book a free strategy session. and we can go through that with you on a one-on-one basis. Now, next week, I actually have a really special guest on the show. He's a best-selling author. He's a bit of a financial guru as well, and he's certainly known for creating some straightforward plans for financial independence. It's definitely one not to miss. So, until next time, though, good luck, happy hunting, and tune in for our show next week. Bye bye.